This is the end of the road. That's what social media has been telling you. I get it. September is not exactly the most bullish month for crypto, though it's starting to shape up to be something decent. It does feel like it's late cycle sometimes. All these things have happened that in some reality should have marked the top. Donald Trump launched a meme coin. He launched a DeFi protocol, all this kind of stuff. Kanye finally launched a coin. But are the macros telling a different story? Has all this has been noise? And if so, what's the story? Well, stick around to find out. Shout out, by the way, to Julian Battelle, head of macro research for Global Macro Investor, who shared a super interesting take on why this cycle is far from over. And so we want to discuss that today and add some of our own thoughts on top of it. One of his points is that the manufacturing sentiment, which can be measured by the ISM PMI, is still very low. Now, for the ISM PMI, you want to score above 50. We talked about this before. That signals business expansion. Below 50 means contraction. For Battelle, extreme bullish PMI should be one of the things that we should consider before thinking that the cycle has peaked. Think 60 or more. It's below 50. Now you might think, wow, but 60 is good, right? Well, that's expansion, yes. But you can think of it like a balloon that you can keep blowing up. There's a point at which it can't take much more air and it pops. Now, a lot of previous cycles have been marked by that metric getting up to 60 or around there. Again, it's under 50 currently. Now, according to research published in Mind Growth and authored by investment strategist Jeremy Fielder, the ISM manufacturing PMI averages 52.9 historically, with cycle peaks typically between 60 and 65. Okay, so no cycle peak until the ISM PMI is between 60 and 65. Bookmark it. These peak values signal strong manufacturing growth before a downturn. With that said, we are still safe based on the current score of 48.7. Remember, the fall starts from the top, right? So you need to get to the top before we hit the other side. We still have a long way to go up that hill. Now, another interesting data point is consumer sentiment. At every peak of a bubble, people tend to believe everything will just keep going up, which has not been the case. Everyone's got horrific PTSD, and every time things go down 1%, everyone's like, it's over, it's going down forever. Just think about the last cycle, admit it. You might have expected Bitcoin to reach 6 digits, going to $100,000 Bitcoin. Slap yourself, Lark. Of course, it topped out at 69K, not 100K, internet man. Slap yourself again. Anyway, the Michigan Consumer Sentiment Index stood at 58.2, down from 61.7 in July, well below its long-term average near 85. The decline reflects growing inflation concerns, worsening buying conditions for durable goods, softer labor market outlooks, all that kind of stuff. But here's the silver lining. In trading, we often say to buy when others are fearful and sell when others are greedy. Consumer sentiment is a key barometer of that. If you look at the Michigan chart closely, in the last 3 major market crashes, sentiment was high before the downturns. Before the dot-com crash, it was 109. Before the global financial crisis, it was over 83. Before the COVID-19 pandemic crash, it was over 100. Today, where are we today? Are we at a top? Fuck no. 58.2. Nowhere near previous pre-crash levels. This suggests consumers are cautious, not euphoric, supporting the idea that we are not yet at a market peak. We are just entering out of this painful period, and a lot of expansion lays ahead. Now, before we get into the next key data points here for you guys, if you're trading these markets, you need a good place to do that at. Check out OG Exchange Femex. I've been using them literally for years. Deep liquidity for altcoins, secure infrastructure, and access from anywhere in the world. That means wherever you are, you can use Femex. You might need a VPN in some situations. It's built for people who demand more from their exchange. Right now, you can deposit $200, make one trade, and instantly grab a $50 cash bonus. But it doesn't stop there. You'll also unlock up to $800 in trading rewards and 1 Solana just by participating, as well as this month's giveaway. 5 traders are each taking home 1 extra Solana each. If you're waiting for the right moment, this is it. Join today. There's a link right down below here where you can get signed up. Okay, so we need to talk about housing, okay? Because real estate is the biggest asset class out there. Owning a home is still the dream, right? Right after owning whole Bitcoin, of course. One before the other, guys. To measure it, we use the National Association of Home Builders, Wells Fargo Housing Market Index, or HMI. So what this is basically a monthly survey of home builders. They rate 3 things: how current home sales are doing, what they expect for the next 6 months, and how much buyer traffic they're seeing. Now, the index runs from 0 to 100. Anything above 50 means builders feel confident, while below 50 shows, well, the opposite. They feel pessimism. They don't think things are going very well. Now, just before the pandemic, the HMI was at 76. Today, it slipped all the way down to 32. Crazy. Now, that is nowhere near the frothy late cycle highs that we've seen in previous cycles, which means if history is any kind of guide, and history is not repeat, but it does have some kind of indication for where we could go, we still got a lot of fuel left in the tank. Now let's check services. And this is important because services make up about 80% of the US GDP. Okay, the US is a service economy, not an industrial economy. Now, it doesn't mean they don't make stuff, but services, baby. In other words, if services are strong, the economy is strong. Well, the ISM services PMI rose to 52 in August, up from 50.1 in July, and even beat forecasts of just 51. Anything above 50 signals expansion. So this again shows the sector is starting to regain some momentum. But here's the key. 52 is good, baby. It's steady growth, but not euphoric. Before the COVID crash, the services PMI was up at 57, much higher than where we are today. If this were truly late cycle, we'd expect the readings to be well above 55, maybe even above 60, overheating before rolling over. Instead, what are services doing right now? They're only just starting to recover, which fits again with the early cycle recovery narrative, which is not what anyone wants to hear. They want a nice clean 4-year cycle, sell in 2 months, go away and come back in 4 years. The problem is that the market may have other plans, the economy may have other plans. If we are really early cycle for the business cycle and all that stuff, oh boy, hold on to your butts, guys. It's going to be real crazy. Another signal is the job quits rate. Basically, how many workers are leaving the jobs voluntarily. In July, it held steady at 2%, right around the long-term average of 2.01% since 2000. Why does this matter? The quits rate measures worker confidence. High quits mean people feel bold enough to leave for better opportunities, exactly what you see in a booming, overheated economy about to peak and roll over. For context, between 2019 and early 2020, quits rates were around 2.3 to 2.4%. COVID hit, it fell to 1.5% after the crash surged, peaking at 3% in November of 2021, which, if you were here, coincided with the effing cryptocurrency cycle peak, man. I remember the memes. People quitting their jobs, no more flipping burgers, I'm flipping you off, boss. I just made millions of bucks in NFTs, I'm out of here. Boom. Fast forward to today, 2%. Just slightly below the long-term average. Nobody's posting I quit memes on crypto Twitter. Workers are cautious, not euphoric. People are clinging to their jobs, clinging to safety. That's exactly what you'd expect in an early cycle or maybe mid-cycle, but certainly not a late cycle top. Again, this is just data here, okay? These are not all my opinions. I have my opinions on the data, but this is the data. We're presenting it for you. You can interpret it as you want. I have my takes on it. You can have your takes on it. And speaking of the last cycle top, the post-pandemic rates cuts flooded the market with cheap money. It's simple. Lower rates mean companies and investors can borrow to expand or even gamble on stocks or even on dog coins, which you know some people did. According to a chart from Macro Micro, over 82% of central banks' last moves were rate cuts. The Swiss National Bank's are at 0%, Japan's at 0.5%, the Euro area is at 2.15%, New Zealand just cut their rates as well. Everybody lower than the US Federal Reserve's 4.5%. No wonder Donald Trump calls the Fed chair too late Jerome. The good news, the market is expecting the Fed to join the party soon. There's extremely high expectation that the Federal Reserve will make an interest rate cut next week. When that happens, it's going to be a huge tailwind for the market. It could be a short-term, very short-term sell the news event, but I would not be surprised the market is absolutely ripped. I'm nuts. Selling and playing it either way. I'm very well positioned in the spot and we're chilling. Now, if you're still skeptical, just look at Bitcoin. It hasn't broken the uptrend that started in 2023. The 100K level has held for support for 11 straight weeks, and psychologically, that's huge. Sure, it can be volatile. Sure, it can still go under 100K at some point, especially with, seasonality, Rectember vibes. I feel like we've already front-run all that bullshit, to be honest. If you zoom out, the bigger picture is clear. The trend is intact. The trend is intact. Okay? Don't go with the feels, baby. Look at the charts. So what's the play? Local top? Not yet. Maybe later this year. Cycle top? Later this year? Also, I don't think not yet. My guess is 2026, maybe even later. The macros from weak manufacturing, consumer sentiment to cautious housing and labor markets, steady but not hot services and global cheap money all point to early or mid-cycle momentum with plenty of room left to grow, which is the answer you don't want to hear. You want it to be over. You're sick of this bullshit. I want out. I want to be free. No more. Sorry, you're stuck here. Deal with it. Lock in. Make fucking money. Nothing in markets is guaranteed, but if I had to bet, which I guess is what I do every day with my money, I'd say this isn't the end of the road. It's the beginning of the next leg, and that all the economic conditions are pointing to, well, things are going to get real crazy, and it's going to be going a lot longer than you think it is. Thanks for watching.